Hello and welcome to my morning note. There is no sadder sight in nature than that of a beached whale, but it's the financial equivalent of a beached whale that is going to be preoccupying attention today, because we will have the results from JP Morgan, at which they will probably have to come clean about the full extent of the damage caused by the notorious whale trade in London earlier this year that lost them some billions of dollars. Beyond that fascinating story, we also have the problem for the investment banks that their revenues are obviously down very sharply in the first quarter of this year compared to the first quarter of last year. Is that something that can be reversed? And if not, are they capable of making the cost cuts necessary to maintain profitability? So there's a lot to discuss. With me now to discuss it is our US banking editor in New York, Tom Braithwaite. Tom, thanks for being here today. What are we likely to get from JP Morgan later on today? How big are the stakes for JP Morgan?
Well, they're big, and I think we're going to get exhaustive detail about the whale, the famous London trading unit whose credit derivatives trades went horribly wrong. They're actually holding an in-person analyst meeting at 7:30 this morning, and that's scheduled to go on for 2 hours. Which is absolutely extraordinary, really, in the last several years. These things are always done by conference calls, right. But they've obviously got a big sales pitch to do. We think the loss estimate will rise, but to 5 billion rather than 9 billion, which has been posited elsewhere. So we think it's manageable, but it's going to be a whale-tastic day on Park Avenue at JP Morgan.
Okay, so beyond the whale then, which is obviously the thing that will quite naturally focus attention, let's take a look beyond JP Morgan today to Goldman Sachs and Morgan Stanley. As you can see, their share prices are back at the worst of '09. There was a widespread sentiment that those two standalone investment banks were going to really do well in the aftermath of the crisis. They'd lost so many competitors. It really hasn't happened. What is the problem for the standalone investment banks, and what do we expect to hear from them this quarter?
Well, you're right. I mean, in '09, though, it looked like they'd regained their swagger and revenues shot up and everyone was happy again. But I think, you know, we now have the endless debate over whether in a cyclical or a structural slowdown for the pure play investment banks. And I mean, their problems are Europe, they would say, predominantly. This is the Eurozone crisis that has shaken the world. People are not doing M&A. Companies are not issuing debt in the quantities they were. So on the fee-based business, the money isn't coming through the front door.
Okay, but if we take a look at revenues, you've got some statistics here from Dealogic. Yes, European revenues are down worse than US revenues, but US revenues are down very badly as well. Where exactly are those revenues going to come from if we do see a recovery? And if not, do they have the ability to make cost cuts?
Well, on the second question first, yes, they do. And I think this week we reported that Morgan Stanley was finishing laying off 100 or so people in sales and trading. And there is still much further, I think most analysts would agree, that investment banks can go there. But, I mean, this is not contained to Europe, as you know very well, John. And if you talk to any US corporate CEO, even though many of them are sitting on billions and billions of cash, they're still not doing deals. They're still frightened that this could spiral out of control. And they're frightened that the US is facing its fiscal cliff at the end of the year. And those sort of double-barreled threats are what everyone talks about, whether the banks or the CEOs. And that's why there's very muted activity.
And basically, as we've said many times before, we need to see the macro situation recover, the macro doubts resolve themselves before there's any real reason to hope for much better. Is that a fair statement?
That's right. But I mean, you've questioned a couple of times the model, and I think that is still an open question. You've got the likes of Wells Fargo, which has stayed well away from investment banking, trading above 1x book, while Goldman and Morgan Stanley trade well below that. And we've had obviously the Moody's downgrade this year, which places further pressure on funding. So I think it's still fair to say that even if the macro situation is resolved, we've got longer term questions over the model now.
Okay, Tom, thank you very much indeed, even if that wasn't a particularly appealing or attractive outlook. I think the message we obviously are all going to be very excited to hear what JP Morgan finally has to tell us about the whale. But whatever their story is on that, the longer term story for the investment banking industry does not sound happy.